Welcome to the Michael and Ryley Podcast. I'm John Howard with Michael and Ryley, a media producer, and I am here with Chuck Simmons today with Motto Mortgage.
Yes.
Chuck, you and I have, we met 2-3 years ago.
Yep.
Right? We got started, or we met each other at a networking event,
Yes.
right? And then that kind of fizzled out.
Yep.
And we continued to meet, 4, 5, 6 of us once a week
Right.
for
A couple years, about a year.
for a year or so. And we had drinks, appetizers, and just
Good conversation.
conversation, whether it be about what we were involved in or the events of the day or whatever was going on.
Yeah.
So you've been in the mortgage industry for how long?
I started in 1997, so 28 years.
Holy smokes.
Yeah. It's been
Have
a
any
while.
plans on getting out?
No. Not yet.
So 28 years,
Yes.
I would imagine over that time you've seen a lot of different things, a lot
Yes.
of different things with the industry, the rates, clients. I would imagine that the process has changed a lot.
When I started, we would get faxed rate sheets. Applications had to be sent in via fax. You had to handwrite them in. So yeah, lots changed.
Now,
Technology's
for all
got a
the
lot
young
better.
people out there, a fax is you wrote something on a piece of paper, you put it in basically a copy machine, and then it sent that copy to another fax machine with a phone line. Not an internet line, a phone line.
Little antiquated.
Yeah.
Yeah.
But my dad had a fax machine almost his entire life as long as I was alive because of the business he was in. So I was very, very familiar with fax machines
Yes.
and what they could and could not do in the role of heat sensitive paper.
Yep.
When it came out and it got to the end and all the faxes were like rolled up nice
Yeah.
and tight.
Yeah.
Had to unroll them and flatten them out and all those sort of things. So we'll just get started with the type of question that I ask almost everybody that's in here, just based on their industry. What's something, crazy that you've seen as somebody who's procuring mortgages for people in the housing industry, in your 28 years?
Yeah. That list is long. We always, when we meet with borrowers and when we're talking to them, we always have do's and don'ts.
Mm-hmm.
And the don'ts sound very basic. It's like most people would think, well, of course, don't change jobs. Don't, have any large deposits. Don't go make a big purchase right before closing. We've run into every one of those. And a few that stick out, I remember I was closing with somebody at the end of November. This was probably 12, 13 years ago. And Thanksgiving, Black Friday rolls around, and all of a sudden I start getting all these notifications that she's opening up all these new accounts. And I had to call her while mid-shopping and say, you can't do this. And she's like, well, what do you mean? I'm getting all these deals and no interest. I said, but every single one of those that you do, we now have to verify it's going to delay closing. And so we had to put a stop to that. We've had, I had one where, and this was back 2003, 2004, when things were a lot looser, but still we have to verify employment. And with a certain borrower, we couldn't get what we needed. They came into closing and we're like, we still have to verify your employment. And so we call the place, finally get a hold of somebody, and they're like, yeah, I can't do this. They resigned a week ago. They're starting their new job next week, and they're not with us. And so we had to stop the closing. And it's not that it was a problem, it's that the fact that we didn't know about it made it a problem. And so we had to stop the closing. We had to say, we need a pay stub, or we need to verify your new employment. So we had to delay things a week or two, which we could have avoided had we known that, a little bit earlier. So
Sure.
I've never had a personal experience, but I have heard where people will go out, they'll think, I've got the clear to close, I'm good. I'm going to go buy my furniture now, and that it hasn't sold yet. And then the mortgage companies get notified. And again, you have to count that in, and it hurts the debt to income ratio. And so I've heard of some catastrophic ones. Luckily, I haven't had anything like that.
Okay. New home buyers,
Mm-hmm.
right? There are maybe things that they expect, when sitting down and looking to purchase a home, whether it's from the mortgage side or the realtor side or those sort of things. What are some things that when they look at the mortgage process, when they either are informed about kind of how the process works, or they're surprised when they find out, what are some of those things that home buyers that they might not think about but are still definitely significant part of the process?
I would say a couple things that stick out. One, they're trained to hear about rate. What's the rate?
Mm-hmm.
Okay, which is a legitimate question, but the rate's not anything we necessarily have control over. We have different investors that have different rates, but really the market dictates that. I more look for them at what are they comfortable with for a payment, because we'll have people come in and they'll be like, okay, we want to know how much we can get qualified for. It could be you could qualify for a $400,000 house, but you only want your payment to be $2,000. Those two things aren't going to match up. And so, especially with first-time home buyers, my biggest question to them is, where do you want your payment to be? And from there, we make sure that we are getting them in a comfortable range, so they're not, because once they start looking in that $400,000 range, they're not going to be happy in that $250,000.
No.
Even it may be a great house for them, but they've already seen what more money will get you, but they just, that payment doesn't fit with what they want. The other thing is, I think, and there's still a common misconception that you have to have 20% down.
Mm-hmm.
That is not true, especially first-time home buyers. 3% down is very common, 3.5% if they're doing FHA. And there are some very good programs out there with less money down. You do have, in a lot of cases, mortgage insurance, so you have a little bit added to your payment, but it's a better trade-off than trying to save up for 20% down. And again, it all fits in with that comfort level for them as far as where they want their payment to be.
Sure. Now, mortgage insurance. First, when does that come into play? And what is it there for? And is it something that's always going to be there?
It depends on the program. So mortgage insurance, first of all, does nothing for the buyer. It protects the lender from risk of default. And where you hear that 20% is, long ago for conventional Fannie Mae, Freddie Mac, they decided that a 20%, if you had 20% equity in your home, then you were really at very little risk of default. So anything over 20%, and any loan to value higher than 20%, they're like, okay, there's a risk you could default. You don't have as much in the game. We need to make sure that we are insured in case you do default. So the banks are the ones who have to buy that mortgage insurance, but it gets paid by the borrower. It depends on the program. So like with conventional, once you hit 20%, that drops off. There's no upfront fee. There are different ways you can pay it. You could pay it in the rate, and basically higher rate, and then the lender pays it for you. You could pay a one-time fee sometimes and not have it monthly. Most people just have it added to their monthly payment. And then once you hit 20%, that is eligible to drop off. It actually drops off naturally when you do your loan, when you hit 78% of, but if you think prior to that, 78% that it should come off, you can call the servicer. They'll probably have you do an appraisal. And if you've got that 20% equity, it'll drop off.
And that's from the original purchase price,
Yes.
or what the Zillow estimated price is.
All based on original purchase price, original loan amount, which is why as homes appreciate, or if you're paying down on your mortgage, it's very possible that you'll be at that 20% well before it would naturally drop off.
Okay. And what's the process of, 2 years ago, houses were appreciating like crazy. Right? If somebody was, let's say, 10, 15% of the way, no, 50 to 75% of the way through their expected mortgage insurance payoff.
Yep.
Right? How difficult is it to essentially contact the lender and get the assessment, do the math to get that dropped off?
Not difficult. You just call whoever, you get your monthly statement. There'll be a customer service number. You call the servicer, and then they will make you go get an appraisal. So you'll have to call an appraiser. That cost is probably $400. And then, so that's where it becomes a trade-off. Right now on conventional with mortgage insurance, if you've got good credit, it's really a small part of your payment. Might be $20 a month, it depends on the loan amount and everything else. But let's say it's $20 a month and it's going to cost you $400 to get an appraisal. It's 2 years that it would take to make that up. So if it's going to drop off in the next year, you might be better off letting it drop off naturally.
And just paying the $20 a month versus the $400.
Yes. Now with FHA, they do mortgage insurance a little bit differently. They charge an upfront fee of, excuse me,
you're good,
of 1.75, and that is to fund the program. So if it's a $200,000 loan amount, that is going to be $3,500 in a cost that gets rolled back into the loan. So with FHA, it is, they have that upfront fee, 1.75%. So on a $200,000 loan, it's about $3,500 is what that cost is that gets rolled in. Then they also have a monthly fee that they charge, and that fee changes a little bit depending upon how much you put down. That monthly fee, FHA always has on their loan, it's for the life of the loan, unless you're putting 10% down. And if you put 10% down with FHA, not everybody knows this, but if you put 10% down with FHA, that fee could drop off after 11 years. It doesn't matter if you have equity, it's all based on years at that point. With a loan like USDA or VA, they don't have monthly mortgage insurance, but they have an upfront fee similar to what FHA has that gets rolled into the loan. And now, like with VA, if you're a veteran and you have any disability, you're exempt from that. But that's how they don't call it mortgage insurance, they call it a funding fee, but it works the same way.
I would imagine that in your 28 years that people come to you and they don't know what they can do, right? So what's the most common reason people think they can't buy, but they actually can?
A lot of people, it is credit. The main things that hold people back are credit and down payment. And so when we talk through, like first-time home buyer, we've got, access to the Iowa Finance Authority, their first-time home buyer program. They have got some great down payment assistance. So, borrowers could get in with as little as 3% down, but then get a 5% loan from Iowa Finance Authority that covers that down payment and some of their closing costs. So that takes care of that piece for them. With the credit, right now, credit, people can see what they think their credit score is on a daily basis through Credit Karma, whatever it is. That is when credit bureaus are run or credit reports are run, there are different versions that people have. And the mortgage version is not the same as like a Credit Karma. And so, what we find is sometimes people will say, I've got great credit, and we'll pull it. And the one bureau that they saw might have had a good score, but we pull from 3 bureaus. The other 2, it could be lower. And so that's never a fun discussion to say, no, your credit's not 700, it's really 630, and here's why. And so on the other side, we'll have people who say, yeah, my score's bad. And we'll be like, well, with your permission, we can pull it. And 2 things. If it is bad, we have a credit simulator we can run it through to try to improve it. Otherwise, it may not be as bad as you think it is. And normally when we do that, depending upon how bad it is, most people know if their credit's really bad. They know if they've not made, if they had a car repossessed recently or whatever. So I'm not talking about that. But in the occasion where they think it's a 660, it's really a 630, but we need, like with the IFA program, a 640 credit score, we can work with them and show them ways to get that score higher.
So when it comes to credit and qualifying for a loan, right? Let's assume all other factors are fairly similar in terms of percentages. You have somebody that has great credit and somebody that doesn't have good credit. What's the difference in the environment when it comes to what they're being approved for? So like because it's, what is today? December 22nd, 2025, right? Yes. So we're talking today's, what are we seeing right now in the mortgage market?
It depends on the type of loan we're doing. Sure. If we're doing a conventional loan, the conventional loans, Fannie Mae and Freddie Mac have what are called loan level price adjusters. And what that means is typically the better the credit score, the less adjusters there are, so the better the rates are. Okay, so I'll give an example. And this is simplistic. There's,
sure.
760 is kind of their gold standard. Okay, so let's say it's 760 with 5% down. They have no adjusters. Okay. If it goes down below that, and it goes in 20-point increments, so 740 to 759, they may have a quarter-point adjuster, which means on a $200,000 loan, it would cost you, that quarter point would cost you $500 to get that same rate as the person with the 760 score. Okay, or it just means the rate might be a little bit worse. So instead of 6, maybe it's 6 1/8. I'm just, again, throwing numbers out. At 720 to 739, that might be a half a point, and adjuster. Once you get below 720, it starts going up to where, like, if at a 660 score, it could be a 3-point adjuster, and those rates really take a hit. Mortgage insurance really takes a hit. And there was a lot of controversy a couple years ago, maybe not a lot of controversy, but a lot of talk a couple of years ago, that what Fannie and Freddie were doing is they were changing their loan level price adjusters. And what they were doing, the way it was being presented, was they were helping out those with worse credit. So those with worse credit were getting better rates than those with good credit. That wasn't the case, but what they were doing was that loan level price adjuster that used to be a quarter to go from 760 to 740 may now be a half, and the 3% adjuster may now only be 2.5. So they were bringing it in a little bit more in line, which was benefiting those with lower credit, and hurting those with better credit.
So it was more linear.
They were trying to make it more linear at that point.
Right, rather than exponential. That's the word I was looking for.
There you go. I knew you'd get it. I had faith in you. It was never that those rates were going to be better. The spread was a lot less.
Okay. On people that actually put loans into place, what's been like the biggest spread in points from the lowest one that closed to the highest one that closed? Right now, we're in the 5s, 6s right now.
Yep.
So So 5 years ago, we had people in the 2s and 3s
Yep.
and stuff like that, right? During that time, what was like the highest rate that you saw somebody close on?
At that time, when rates were, say, 2.7,
Mm-hmm.
if we're talking primary residence but just bad credit,
Yep.
probably 4.5,
Okay,
5%.
so
A two to
2 to 2.5 to 3% spread.
Yes.
Is that similar today? Is it usually that 2.5, 3?
It's hard to say because there's so many different factors that go into
Sure.
it. But yeah, I mean, I think that spread, where we've seen a big difference lately is the price adjusters that they put on second homes and investment properties is huge. So when the pandemic hit, all these people were going into the Floridas and buying all these, and they wanted to put a halt to that. And so the way they did it was they made them pay, and they put all these price adjusters. So either higher rates or more cost to get it.
And by price adjusters, I just want to clarify, these are things that they see in your situation that are causing that rate to go up or go down,
Yes.
right?
So if on a $400,000 deal, there's a 2% price adjuster, that's $8,000 it's going to cost to do that same loan. Okay. There are a few ways you can do it. You can pay cash, or, pay it at closing, or it just gets built into the rate. So your rate goes up. So you won't have that out of pocket cost. You'll just have that higher rate.
And this comes from like a standard purchase, right?
Yes.
Right. So this would be a non-standard purchase, whether it be second home or some other factor,
Yep.
right? They're paying 2% more than the standard person, given everything else is the same.
Yes.
Okay, gotcha. What's the difference between a pre-approval and a pre-qualification?
Well, everybody has their own interpretation of that.
Okay, what's yours?
I'll give you my definition. So, a pre-qualification means you don't want me to pull credit. You want me to run numbers and basically get an idea of your income versus your debt. So it's a lot of, okay, what's your car payment? What's your credit card payment? And from there, what I will tell them is, based on what you've told me, this is the amount your house payment can be. Okay. It's not worth anything. I don't know that you can get a home. I just know that the numbers work based on what you told me. Pre-approval means I pulled credit. I may or may not have looked at your income. It will have a conversation. And if you're salaried and you know how much you make, you're not, I'm going to trust in a lot of cases. It depends on the borrower. But if you can come to me and say, I'm salaried, I make $53,500. Okay, you know how much you make. So I pulled credit. I've seen your debts. We've had those conversations. I've asked for the income documentation, but not, they don't have to send it to us before we need to send out a pre-approval letter. So again, I may or may not have seen that. But at that point, I've run through everything with you. And if I'm giving you a pre-approval letter, then I'm confident I'm going to get that loan closed. So, and the agents that I work with know, if they get that letter from me, that I've done all the work to know that we're not going to have any issues unless something unexpected comes up.
So the pre-qualification is basically running the numbers and saying kind of, hey, here's kind of the payment that you're looking at. Right?
Yep.
Then taking that, backing it into, okay, here's what we believe you're going to qualify for with the rate.
Yeah.
Right? Then that math backs into, okay, here's the range of house that you are pre-qualified.
Exactly.
For.
Again, and I always say, based on what you've told me. Based on the credit score you've told me. I just had one where the credit score that they told me, I ran numbers on for them and gave them a rate, and they liked the rate. Their score was quite a bit lower. We could still do the deal, but not at the same rate. That's the danger of a pre-qualification.
Sure. Have you ever had a Superman moment where you flew in and saved a deal at the last minute?
Yes. I mean, one thing I don't know if I would call it a Superman moment, but I pride myself on knowing the guidelines very well. And so I know when we can do things and when we can't. And so if somebody calls me and they'll give me a scenario, I'll know if we can get that deal done. In fact, the one right now that I'm working on, borrower just isn't getting the answer she wants. It's a out-of-state lender, isn't getting the answer she wants, should have closed a week and a half ago, isn't for whatever reason. And so I've got it and we're getting it done. So that's good. We had one where a borrower, and it was our deal. So it wasn't me swooping in on somebody else that dropped the ball.
Mm-hmm.
It was a borrower who we had to repull credit because credit had gone on, and when we credit expired after 120 days, we repulled it. Their score dropped 100 points.
Oh,
and it changed everything about the loan that we had to do.
Yeah.
And so, it was a VA loan. It was a higher debt to income ratio. And we had to really sit down and start making sure we understood the guidelines. And what we were able to do was, because now their debt ratio was too high for the program we were trying to do, VA has a few quirks with it. And we were able to go back to the seller, increase the purchase price, increase the seller paid costs, and have the seller pay off some of the borrower's debt, get the ratios down, and get it closed.
Wow.
So, yeah, there are a few where we sit there and after closing, we're not sure how we got it done, but we did. So
that's one of those things that, it's just like anybody who reads the law or reads the tax code or, really understands those things.
Yeah.
There are ways to legally finagle the numbers.
Yeah.
Right. And I haven't heard much about it recently, but when it first got announced, I just went, you've got to be kidding me. But the 50-year loan.
Yeah.
What are your thoughts on what that will do to the industry if that actually becomes a thing?
I'm not a fan of it personally.
I'm not either.
But when you look at it now, people have a choice between a 15-year and a 30-year.
Mm-hmm.
Okay, most people will do that 30-year knowing they're paying more interest over time
Mm-hmm.
because that payment comes down. So in a sense, this is really no different than that. But on the other hand, if you actually run the numbers, the amount of monthly savings between a 30-year and a 50-year compared to how much more you're actually paying,
Mm-hmm.
I don't think financially justifies it. It'll help some borrowers, but not a ton because, again, that payment difference is not as big as you would think it is.
It's negligible.
Yeah.
Yeah. One thing that I've looked at in all the industries that I've been in or have experience with or whatever, my thought on it is all it's going to do is it's going to drive the prices up.
Right.
Because if today at a 30-year mortgage you're paying $3,000 a month, right, on whatever home, whatever rate, $3,000 a month, if you bring a 50-year mortgage in there, even though it's negligible, right, I still think you're going to push that payment to that $3,000 a month.
Yeah.
Over time.
Right.
I mean, if and when it comes out, people are just hopping on it right away, I think there would be some potential savings there per month, even though it's negligible.
Right.
But over time, just like I would say the medical industry with health insurance, I think those costs have, I don't have any data to back it up, but I would imagine that the cost of the amount of money that the medical industry is able to collect has increased dramatically, right? which has increased income for medical professionals, which then has increased schooling costs, right? Because, well, they're making more, now they can pay more, right? Which then has increased what people are doing for student loans. And it's just this massive wheel that goes in the wrong direction.
Right. Well, and again, the intent, just like what you're saying, the intent of doing a 50-year mortgage is to make things more affordable and to bring that payment down. But in reality, I think what you would find more often than that is people using it not to bring their $3,000 payment down to $2,800, but to, with that $3,000 payment, instead of getting a $300,000 house, they're able to get a $320,000 house.
Sure.
And that would bring those prices up. So,
yeah, I'm not a fan of it.
I'm not either.
We talked about this a little bit, and you touched on somebody that the closing of the deal got pushed back because of something that happened, right? Have you ever had a client where it just didn't get done? Like, hey, you went out and did XYZ, and it wasn't a change in a financial situation, right? Somebody didn't lose their job or, that sort of thing, but they just had a bonehead move. And
not one where it happened at the last minute, but we have had it before where, it was, again, and a lot of times it's repulling credit where everything's been good, and then all of a sudden there'll be a late on a car loan or a late on a mortgage, and they didn't know that things were going to take as long as they did, and that repulling credit is always I always say there's nothing good that can come from us repulling credit. So if I can avoid it, now, if I'm working with somebody on their credit score and we're purposely trying to bring that up, then yes, we do a rapid rescore. But if it's 4 months down the road and I have to repull it, nothing good's going to come from that. It's only bad things that can happen. I had one recently, and this was not a boneheaded move by the borrower at all, but day of closing, they're like, we've decided we're not going forward with this house. And that was because about 4 days prior to closing, they realized that there was a bat infestation that could not be taken care of until the spring. And I thought buyers and sellers were working through it, and the buyers ultimately decided we can't live in that house, because there's nothing they can do to stop the bats from coming in. And, the insulation has to all be redone. But, and that was like 2 hours before closing where I got the call, and they're like, we're not moving forward. But I fully understood.
Yeah, no.
So not a boneheaded move, just an unfortunate circumstance. And there's always little things like that. But that was, when they told me, they called and they were very apologetic. And I'm like, no, you don't have to apologize. This is all about you guys and what is right for you. And if that's not, the right move for you to move forward, I fully support that.
What are some creative things that people are doing right now to help buyers, that are coming potentially out of those 2s and 3s into 6s, the rates? What are people just not selling because they're sitting in those really low rates, or
there's a little bit of that?
What are some things that you're seeing right now, creatively, that whether it be sellers, buyers, whoever, or, people in your profession that are doing to help people get loans, make them more affordable, reduce the fees, those sort of things?
The biggest thing right now is a temporary interest rate buy down. And so there are two different types of rate buy downs you can have. You can have a permanent buy down where, and we talked about those loan level price adjusters. Let's say you could pay a half a point and get your rate down an eighth or a quarter. Okay, so let's say your rate was going to be 6.25. $200,000 deal. You could pay $1,000. Again, I'm just throwing numbers out there. $1,000 to get it at 6.125. Okay, that may save you, depending upon the loan size, $15, $20 a month. Okay. The danger to that right now is and I've been saying for 4 years, we're about to see rates come down, and they have not, not significantly. They've been coming down, but the Fed's been lowering their rate. The mortgage rates have not followed in step necessarily, but the Fed has lowered their rate 6 times in the last basically year, just over a year, which is, prior to that, they had been on a cycle of raising their rates. So it's all catching up now. And so I do believe we are in a spot where rates are going to continue to come down, at least for a little bit. So if somebody does a permanent buy down, the danger to that is if they're paying $1,000 to save $20 a month, they need to be in that loan for 50 months for it to pay off. They have to have 50 months of savings. If rates start coming down in the next year, like they're expected to, they're going to refinance prior to that, and they're going to lose money. And so that doesn't make a lot of sense. So I'm not a huge fan. Now, if you've got seller paid costs and you have to use them, then we'll use it to get them a better rate. But in general, I'm not a huge fan of using that money to buy that rate down, because it's all about, for me, break-even point. The temporary buy down allows them to get like a 1-year buy down would be 1% below what their rate is. So if their rate's 6.25, they're getting 5.25 for a year. That has to be paid by the seller. It can't be paid by the buyer. So it has to be negotiated as a part of that. The cost on that is roughly just over 3/4 of a point. So on a $200,000 deal, that cost will be about $1,500 or so. The savings for the buyer is that same $1,500. So whatever that savings is dollar for dollar what that cost is. You can do that a few different ways, though. You can get creative. You can do a 2-1 buy down, which means it would be that rate would be based on 4.25, so 2% below for the first year, then 5.25, so 1% below the second year. That may save them $5,000-$6,000 in those first couple years. Depending upon how much you get in seller paid costs, they also will go to a 3-2-1 buy down, which would get that rate down 3% the first year, 2% the second year, 1% the third, and then kick into the normal rate. The problem with that's real cost prohibitive unless it's a special situation. That costs about 4.5 points. So on a $400,000 deal, that's about $17,000-$18,000 it would cost a seller. Unless the seller's desperate or whatever the situation is, typically that's not how much you see the seller contributing.
Sure.
So we see more 2-1 buy downs. The nice thing about the 2-1 buy down, I say the rate's lower, the rate's not. Your rate is still 6.25, but what happens is those funds go into an escrow account, and out of that escrow account every month, the seller's portion is applied, so you only pay the difference. So your payment is based as if it were that lower rate. If the rates come down and you refinance, whatever's left in that escrow gets applied to your payoff. So you get all of that money back.
Okay.
So that has been, hands down, one of the best things that we've seen and that we use quite a bit.
Perfect. When it comes to points, dumb that down for me and explain because you're using the word point. We're talking rate, right? What is a point, and is it a specific thing, or does it mean different things on?
So you may have heard the term origination fee or discount points. They're really the same thing. Okay. An origination fee. So if if somebody's charging like a 1% origination fee,
Okay.
that's 1% of the loan amount you're being charged to get whatever rate. Okay.
So I come to you for a $200,000 loan. It's going to cost me $2,000 to put that loan together.
For somebody who is charging an origination fee. Okay. You'll hear places say, oh, we don't charge any origination fees, but they'll charge discount points. It's the same thing. It's categorized a little bit differently, but one discount point is 1% of the loan amount. So you've always got to ask that follow-up question. If somebody says, oh, there's no origination fee, well, are there any points? You know, what is that? So when we quote rates, I'm only speaking of myself and my team, we're very transparent. So when I used to be at banks, before things got regulated, it was the Wild West, and people would charge rates much higher than where the going rate was, and that spread above and beyond what they could have charged and everything else, the originator would get paid on. They would, maybe they could split 50-50 or whatever. That got regulated with the financial meltdown back, you know, Dodd-Frank and all of that. So now the originator does not make more money if the rate's higher. Okay, so that can't happen anymore, which is a good thing. But you know, when we quote rates, we show them. So banks can round up or round down. So they could say, you know, it may be that at 6 1/4, it's going to cost 0.421 points, some odd number like that.
So 0.421 would be 0.421%.
$100,000 deal, it's $421.
Okay.
Yes. Okay. So they may round up and say it's a half point to get that. Okay. The bank can make that extra, the originator can't, in that case. Well, on our side, because we're a mortgage broker, and we have contracts where, you know, depending upon how we do it, we have to charge exactly what that is. And so if it's 0.421 points, that's what we are quoting. That point is designed, again, to get that better rate. So it may be that at, again, 6 1/4, there is a little bit of a fee, maybe 0.02, whatever it is. At 6 1/8, it's going to be a 1/4 point. At 6%, it's going to be a half or 5/8 of a point. All of those points are costs to get that rate down. And that's where we talk about break-even point, whether it makes sense to the savings to the cost. On the flip side, if I went 6.375, they may get a credit of a 1/4 point. Okay, if I go 6 1/2, they may get a credit of a half or 5/8 or whatever it is. So when we're working with borrowers on when to lock, we're showing them, if you don't want to come in with as much money, you could go with a higher rate. And then you'll get a credit from the lender, or if you want a lower rate, here's the cost to get it. So we're normally giving them about 3 options as far as that goes.
Okay, so the point is a multiplier based on
Loan amount.
the loan amount.
Yes.
So if a rate comes at, I don't know, 6.5%.
Yep.
Right? And it's going to cost them 2 points to get it to 6 1/4 or 6 or whatever it is.
Yep.
Right? So 2 points would be 2% of that loan amount.
$200,000 deal, $4,000.
That's what it's going to cost them
Yes.
to drop that rate.
Yes.
Okay, so a point is a multiplier.
Yes.
Okay. Used in the industry based on the loan amount to basically give you the cost of what it's going to cost the...
It's a pass-through for us.
Yeah.
Yes.
Yeah. I was trying to figure out...
We're not making any money on the points.
Because I hear points, and,
Yeah.
you know, it's, well, this is going to cost you 2 points.
Right.
Well, a point is a multiplier based on the loan amount.
Right.
Where a point for a $200,000 loan is going to it's going to be less dollars than a point on a $400,000 loan.
Right, because it's a percentage.
It's not a set amount.
Right.
It's a set multiplier
Yeah.
of the purchase price of the home.
Correct.
Perfect.
And you know, one of the little tricks that you'll see lenders do out there, especially now, is, you know, I'll see a lot of them that are saying, you do your loan with us, and we will give you a year or 2 years or 3 years where if rates drop, then we're going to cover your costs for that refinance. Okay. There's nothing special they're doing. What they're doing is they're just going to make sure they price it with a credit instead of a cost. And so on a $200,000 deal, you know, as rates come down, they're going to make sure they price it with a 1-point rebate so that that $2,000 cost to refinance is covered in that rate. So again, you have to ask a lot of questions when you're talking to people to make sure you understand it, because nothing's free as far as that goes. They're getting the money somehow, and you shouldn't have to feel like you have to work with your current lender, because anybody can offer that.
Sure. What are some good questions if somebody's stepping into buying a house, whether it be it's been a long time,
Yeah.
right, or they're a new home buyer? What are some great questions that they can ask to get the information that they need to make sure things are on the up and up, or, you know, there's nothing hidden that that they might discover later on?
Well, things are, again, regulated more now. So if they get a loan estimate, they should always ask for a cash to close worksheet or a loan estimate. And that will, if they get the official loan estimate, that will show the costs that have been estimated as far, you know, from the lender. What happens is once that loan estimate goes out, there are a few fees that you might be able to, you know, let's say you said a credit report was going to come in at $100 and it came in at $120. That's allowable. But there are others. Let's say you said that, you know, appraisal fee was going to be $600 and it came in at $650. Okay, those get rebated back. You know, the lender's responsible. They can't just raise fees at the end. You know, and so I would get a loan estimate or a cash to close worksheet so that you can see, again, if somebody's saying we don't charge an origination fee, well, are there points being charged for that rate? You can see where the other costs are coming in. Make sure that, again, pre-qual versus pre-approval, you know, has an underwriter seen this? No, we haven't sent it to an underwriter yet, but we have an automated underwriting system that we've run it through, and here's what it says that we need. So, I mean, you just need to have a feel that they've done their job, you know, that the lender's done their job to make sure you're not going to run into any, you know, potential unknowns later on down the line.
Sure. Any other words of wisdom you want to share with potential buyers from your point of view?
I would just say it never hurts to get a second opinion. Okay, so shop around. You know, a lot of people are worried if their credit gets pulled that, you know, they don't want all these places pulling their credit. When it comes to the mortgage side, any credit pulls that happen within 45 days really count as one inquiry. It'll show as multiple inquiries on your report. But that changed back when I started, when things would get faxed way back when. We would send things out to 4 or 5 different lenders. They would all pull credit, and the lender who pulled credit first normally got the deal, because every credit pull after that hit the borrower's credit and made it worse. Now that doesn't happen because they realize, and you know, not like a credit card where you could go out and get 3 or 4 credit cards at once. Even if you're talking to 3 or 4 lenders, you're only going to end up probably with one mortgage. So it counts as one inquiry. So shop around, get a second opinion. if you don't like what you're hearing, or if you're being told no, it could be that where you're with, there are certain banks out there that have credit overlays. And what that means is, for instance, they may say you may have a 600 credit score. Okay. Their bank policy may be, if you don't have a 620 or higher, we can't do anything, and they'll tell you no. And so if at that point you think, well, that's the answer, I can't buy a home, that's not true, because we have a number of lenders. We actually have lenders that would go down to a 500 credit score. Now, that's not easy to do, but at a 580 or above, we have a number of lenders where we can get deals done, FHA or whatever it is. So just because one place is saying no, make sure you're checking with a few others, because guidelines and overlays and everything else may be a little bit different, and there may be a way to get you into a home.
One of the benefits of working with a broker versus like a bank or something like that, because in today's regulated banking world, it's more about what people know, not who you know. I remember growing up, my dad knew the president of the bank.
Yeah.
Right. And he was able to get I don't know if it was a personal note or if it was a note against the whatever. He was able to get it because the bank president signed off on it, and there was that relationship there. I don't see that happening near as much today.
No, in fact, a lot of the major banks have gotten out of the retail lending. You don't see a lot of the bigger banks that used to have an originator in every one of their banks on the corner. They aren't doing that anymore. I will say, when I first started in this business, so in '97, I was living up in Minnesota, and it was with a broker. At that time, it was not regulated, and it was a very shady side of the business. And I didn't like it. And that's when we made the decision to move down here. I went onto the retail side with the banking, thought, I'm done with the broker side. It's not a side I feel comfortable with. Well, then all the regulations happened. And, with the meltdown in, the 2007, 2008, there were really no brokers around anymore, because that was where things became the Wild West, and it hurt the industry. And so as things have gotten a lot more regulated, we've started to see brokers come back, and that's when I made the decision to buy the Motto franchise. I did a lot of research. I had been on the retail side for a long time, and I saw that there was an opening for places that could do a little bit more. And again, because the overlays that the banks have, not everybody has, the overlays are different, so not every bank has them, or they could vary. But there was a market out there where having the ability to, and just to explain, most banks, unless you're a major giant bank, that they have their own loans, they have their own rules. Okay. Most banks have their underwriting staff there. They can underwrite on behalf of the lender. And then after the loan closes, they sell it to whoever that bank is. On our side, on the broker side, the only difference is we are working with those other institutions, and instead of selling it on the back end, that's who we're placing it with on the front end. So it's closing in their name. So, whether it's a United Wholesale or a New Res or whoever that may be, we know their guidelines. We are working with their underwriters, and we are making sure ahead of time that we are meeting everything. And it's just basically closing in their name instead of being sold on the back end. That's really the only difference. And so what it gives us, though, is that ability. Like I said, I've got investors who will do a loan down to 500 if we need to. I've got one I'm doing right now where the borrower is self-employed. They make good money, but they write it all off. And you know, they're trying to find, you know, this is the one where the lender was having issues with it. It should have closed by now. Well, we've got a 1099 loan where she's basically gets 1099 a year from the contract that she has, and we are able to use that 1099 income. We don't have to look at the tax returns. Subtract 10% for estimated true expenses, and we're able to get that done. That's not something that a lot of banks will do. They have in-house loans that they might do, but for the most part, it's one of those things that gives us options to, if we can't get it done, chances are there's not much of an outlet for it anywhere.
Sure.
So that's one of the benefits on the broker side with it.
Well, that's nice.
Yeah.
That's nice because, you know, small businesses, depending on how they're running everything, you know, yeah, we're writing off all of our equipment. We're writing off all the, you know, purchases during the year, and being able to work off, you know, different numbers or something like that,
Right,
is very beneficial
Yeah.
for us. I don't know that I have much else for you today, Chuck.
All right.
I think we've gathered a lot of good information that can be out there, you know, for people to research and find those sort of things.
Sure.
So thank you for coming on today.
Happy to. Thank you.